Good morning, everyone, and welcome back to the Sensa Edge. This is your host, Zoheb. Today, we are diving into dicey topic of tariff and how to play continued downside in Ford using a vertical or a diagonal spread. Why? Because the tariff situation is a bit messy. On again, off again, on again, off again. It's like an abusive relationship with the really excellent physical chemistry. They're inventing new types of graphs to track tariff policy activity with the administration. If you have been watching the ongoing tariff drama where every new policy announced is promptly walked back like a toddler who touched a hot stove, you know the auto sector has been in a state of perpetual whiplash. Ford, in particular, has been taking it on a chin, oscillating between maybe we can recover, oh no, not again. But blindly shorting Ford isn't the answer unless you like paying an infinite borrow fee for the privilege of losing money. Instead, let's see how we can play the smarter option-based approach, vertical spreads and or diagonal spreads. Quick check on the force, right? Let's address the elephant here, or should I say the F750 in the room. So there's no F750 of Ford, but give it some time. Ford is caught in a death spiral of tariff uncertainty, supply chain woes, and demand concerns. Every time it looks like there's a break in the clouds, a new policy change smacks it down. 1 week tariffs are up, bad for business. The next day tariffs are lifted, great news. Then a few days later, around the same tariff is announced, leaving Ford investor feeling like they've just got invited to a party only to find out it's a time-sharing presentation. The stock has been forming a pattern best described as controlled demolition. Lower highs, weak rallies, and a general inability to hold trend suggest that the best way to trade this isn't through the aggressive shorting, it's through the calculated bearish play. Let's take advantage of that and the volatility premium and controlled downside risk. Now let's get tactical. If you think Ford struggling will continue but don't want to get crushed by surprise tariff rollback, the key is structure your trade in a way that benefits from controlled downside rather than unlimited risk. Let me bring my screen here and then let's jump into it. As you can see on the sensormarket.com, Ford currently has been like, oh, it's getting down in the bearish 9.9. If I go into the news category, stock news, I can see all the latest news on the Ford coming in. So you don't miss anything. And then we capture all the latest news coming in particular to the Ford, because you want to like deep dive over there. The strategy, what we are looking at is when you go to the option strategy builder here, I've already selected a put vertical spread. This is a debit spread here, and it is a bearish spread. If you can see here, I'm going to make the screen slightly bigger. Here, in this case, I am buying a put here of $11 somewhere around May 16th and selling around 9.85 put. In this case, what I'm shooting is if the stock rallies to continue downwards below like 10.38 here, in this case, the break even, I'm going to make profit. A quick profit. Again, the debit looks like 1.46. The contract to enter will be multiplied by 100, which is 147. A profit margin of $53 in this particular case. Let me jump in very quickly here just to talk more about this. Right. Again, before I jump into the next strategy, why this particular strategy works. The play keeps you risk defined while allowing you to profit from continued downside. If Ford grinds lower, the spread will gradually increase in value without exposing you to violent squeezes that sometimes accompanying shorting individual names. Option number 2, let me jump into this one more tab here. Again, you can go to the option strategies. I kept it really there. This is the diagonal, bearish diagonal spread. Again, this is completely puts as well. What I'm trying to do here is selling here, as you can see here in the screen, selling somewhere around 9.85 worth of put for May 16th and buying a put of somewhere around $11 for June 28th. So again, as you can see, the green is where the profit is. Anywhere below 10.41 is where I gradually make profit. In this case, the profit from a continued downside while collecting a premium decay from a short put. Again, you might ask why this particular strategy works. This strategy takes advantage of the elevated volatility on the short-term leg while giving you long exposure via the back month put. If Ford drops quickly, you still make money. If it drifts downward and you collect premium from the short put, expiring worthless and make money from the downward drift with the June puts. Again, why this trade work in this particular environment? Ford's price action suggests continued weakness, but outright shorting can be dangerous. Given the potential for sharp bear market rallies fueled by policy shifts, these situations require care from a volatility standpoint. Buying put outright when volume is sky high usually means overpaying, like paying 30,000 for an Escort. The car Escort, a Ford Escort. Here's why vertical and diagonal spread shine. The limited downside risk you define your maximum loss upfront, unlike shorting shares outright. They benefit from the IV from the staying high as long as the tariff remains uncertain. Implied volatility will remain elevated, helping the diagonal spread collect premium and maintain value, while the vertical spread takes volatility more or less off the table. They capitalize on this controlled thing. Selling or collapse. If Ford makes grinding lower, you profit without needing an immediate collapse. If chaos unfolds, all better for your position. Again, we're not evil here. We're just betting the right strategy here. Again, you are playing chess while the others play checkers, except in this case, the checker players are losing money by shorting blindly and getting squeezed out every other week. At some point, the Ford has to bounce or will bounce. It always does. Whether it's a government bailout, a surprise demand surge, or just market makers deciding it's time to punish shorts, be prepared for the temporary recovery. That's why blindly shorting doesn't work long term. Instead, stick to the structured plays where even a choppy ride still puts money in your pocket. If you time it right, the diagonal spreads might even let you roll down a leg for more profit. And in my experience, there are few things I like rolling down my leg, but profit is an exception. All right, let's bring back myself here. Again, that's it for today's episode on the Sensa Edge. If you're still hoping Ford is a magical recovery while tariff are bouncing around like a room full of kindergartners, it might be time to reassess your outlook. I'm personally hoping for a secondary offering to finance the rollout of FC750, a 3-ton ATV for a military use. But does Ford call and ask for my opinion? No, they do not. All right, trade what's in front of you, not what you want to happen. And if you're looking for a way to profit from a Ford slow-moving decline, vertical, and the diagonal spread, which we just saw, is a solid bet. Thanks for tuning in. Be sure to subscribe, leave a review, and follow us on the platform. Until then, trade safely and allocate responsibly.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.